So for our next paper, I think we can now move on to our paper on founding family heritage, social background, and risk-taking. Ankit, are you here?
Yes, yes, yes. Shall I share my screen?
That'd be wonderful. Thank you.
Can you see my presentation?
Perfectly.
Okay. Thank you. So, good evening, all. First of all, I would like to thank Emerging Market Finance Conference for giving us the opportunity to present our paper. And also would like to thank Mr. Shri Vatsan Rajan for acting as a discussant for my paper. So this paper titled Founding Family Heritage, Social Background and Risk Taking by Family Firms is the second part of my thesis at Shiv Nadar University. And the co-authors for this paper is Professor Ramashet from Copenhagen Business School and Professor Vishwanath from Shiv Nadar University. So they both are in the call. So if they may also intervene to answer your some of the queries. So one of the central theme in family business literature is whether family firm take more or less risk. So we try to address this question in the light of some relatively unexamined factors such as growth opportunities, product market competition, ethnic background of founders, and the culture heritage of families. So there has been, what are the motivation behind this paper? So there are a couple of empirical studies which examines the impact of ownership concentration on risk taking, but are likely to yield some of the inconsistent results. For example, from the financing perspective, Anderson, Mansi, and Lee find that the family ownership is associated with lower cost of debt financing. So in a sense that they assume family firm decisions to be less risky. From a investment perspective, Fetcher et al. Find that diversified large shareholders undertake riskier investments. And also in an international sample, John Litov and Young find that there is no significant relationship between family ownership and corporate risk taking. So there seems to be no consensus on the fact that how ownership concentration impacts the risk taking propensity of the firm. So as we dig in the literature, we find that there is no direct text of whether family firm take less risk or more risk. So we show that in general family firm are less risky, but not all family firms are the same. So in the sense that the behavior of the family firms at higher and the lower level of ownership is not same. That is, there exists a non-monotonous relationship between family ownership and risk taking. So at of ownership, family firms tends to be conservative, but as the ownership increases, they may take more risk because they have more skin in the game. So they at higher levels they may also take gambles at the expense of lenders and also pledge their assets to save the firm. So, for example, Kingfisher, Jet Airways, and Esser are some of the examples. So in the literature, family pride, CEO overconfidence, and board effectiveness are the possible reason for this kind of pattern. Another motivation is, for this paper is the unique caste system that prevails in India. So we posit that the biological disposition also plays an important role in determining one's risk-taking capacity. So for example, the Indian society is divided into 4 different castes, that is Brahmin, Kshatriya, Vaishya, Sudra. So our focus is primarily on Vaishya because these are the communities which undertake business opportunities when they arise. So there are several, under each category, there are several subsects or castes that can be easily identified by their surname. With the evolution of the Indian society, although this dilution has been, this segregation has been diluted, but even now, but the society still adheres to the same pattern even now. These business communities facilitate wealth generation because they undertook a lot of business activities and they play an important role in facilitating wealth generation by the family firms. So in that sense, we can say that the person who firms founded or led by the people or the person belonging to the business caste or someone who does not may have an important implication for their risk-taking capacity. So in that sense, we posit that the firms belonging in which the founder belongs to a business caste tends to take more risky. Another motivation for this paper is the presence of the older business families in India. So most of these families were even older than independent India. So they undertook trading, manufacturing, and also so they undertook those. So what kind of companies they are? Like they are Tata, Birla, Murugappa, Ambani's, Thapar, and Wadias. So some of these prominent Indian businesses are older than independent India. So consequently, the affiliation to one of these older family may be also be detrimental how they take risk. So in that sense, we posit that the firms belonging to older business family may be less risky in terms of cash flow volatility. So the contribution, our paper aims to add to the existing literature that examines the managerial background, skills, and traits that affect the decision making. So there has been an empirical evidence which examines CEO overconfidence, their managerial trait, disaster experience, and CEO gender, which has an impact on the firm's riskiness. So in this regard, we add to the literature by claiming that CEO social background is another important variable that may explain the differential in corporate risk-taking choices. So the background in India, the family, so 73% of the firms in BSE 500 index are family-owned business. So that is pretty much a fair representation of the firms. So they hold usually a high level of equity ownership, that is near about 49% as compared to other economies in the world. And this is primarily because of the less developed institution, capital market, and the poor legal protection for external investors. So this has prompted the outsider shareholders to demand higher involvement in the firm on the behalf of the founder. So in that sense, founder have both the incentive to take risk as well as to be risk averse. So these are the main preview of our main findings, that family firms exhibit lower cash flow volatility, earning volatility, and equity volatility after controlling for competition and growth opportunities. This is true for firms when they managed by older business families. We also do find some evidence that firms managed by family CEO belonging to business caste are riskier. We employ a couple of robustness tests to counter the endogeneity concern in our study, and we find that our results are robust to all of these alternative methodologies. Finally, we explain our result by examining the extent of diversification, leverage choices, and cash holding of families and non-family firms. So the data includes 510 firms that are listed on National Stock Exchange. We collect our accounting data from Provis, that is the standard source of financial information in India. To collect stock price data, we rely on National Stock Exchange website. So this is one of the main points, that our definition of family firm is consistent with the definition that exists in Chua et al., which says that family firm is one which is set up by individual or family at the beginning. Or it has the founder or the founding family member as the CEO, or in the founder or the founder family holds at least 50% of the voting stock. So the variables we use here is that the standard deviation of multi-stock returns, standard deviation of cash flow from operations scaled by total assets, and finally we also take earning. Although we know that it comes with a lot of noise and also prone to smoothing, but still it can be used to measure risk taking of the firm. We use an overlapping 5-year window from 2001 to 2015, and our explanatory variables are family dummy, family CEO. We interact business caste with family CEO, and also we interact old business family with family CEO. So our hypothesis says that we expect that competition and growth opportunities play a moderating role in explaining the relationship between family ownership and risk taking. So as a corollary, we expect the involvement of family is associated with less risk, that is in terms of volatility of stock return, cash flow, and earnings. And we do find a strong support for our hypothesis. In the similar vein, we expect a curvilinear relationship between family ownership and risk taking. That is, at lower level of family shareholding, they have less incentives, but as the ownership increases, they have better incentive. And we do find a strong support for our hypothesis. Thirdly, we hypothesize that the firms owned by older families may take less risk, and this is primarily because they have the desire to bequeath the firm to their successor, and we do find a strong support. And finally, we hypothesize that the firms headed by family members belonging to a business caste would be riskier, and in that respect, we also find the strong support for our hypothesis. So this is the preliminary statistics for our variables being used in our study. So some of the variables are very self-explanatory. As you can see here, that family firms exhibit less earning volatility and stock return volatility as compared to non-family firms. And also although the cash flow volatility is not significant, but family firm exhibit lower cash flow volatility as compared to non-family firms. So the dependent variable is volatility of stock return. As you can see that all our family firm variables are negative, which shows that they exhibit less stock return volatility. But if family CEO belongs to business caste, it gives you the positive variable, for the positive coefficient with 1% significant. So it means that the family CEO, if the firm in which the leadership position is held by the family CEO and he or she belongs to a business caste, they are taking more risk. We replicate our study using different dependent variable, that is volatility of cash flow. In this, as you can observe, all the family firm variables are negative. And also in this family CEO belong business card, they exhibit less volatility of cash. So it means that the business caste in the firms in which family CEO belongs to a business caste exhibit higher stock return volatility but lower cash flow volatility. So we can expect a non-linear relationship between cash flow volatility and the family ownership. We replicate our using different dependent variables, that is volatility of earnings. In that, we also see that all the family firm variables are negative, and we do expect a U-shaped relationship. And in this, we find that if founder belong to a old business family, the coefficient is significant, which says that they have more stock return volatility, which is what we would not have expected, but the lines of the Adam et al. Finally, we know that their endogeneity is a concern in our study. The concern is that whether family firm take less risk or the less risk prompts family firms to maintain holdings. So we ran a couple of robustness techniques in which we use instrumental variable regression, and we model family ownership as a variable. As you know that ownership is a function of firm size and risk. So we model family ownership as a function of size square, and risk. And we do find that there exists a relationship, which is the possible explanation of the stock return volatility curve. Similarly, we employ propensity score matching, and we do find that our results are also robust to PSM. So these are the results in which family firms exhibit lower stock return volatility as compared to non-family firms. Similarly, less cash flow volatility as compared to non-family firms, and similarly in the context of family firm variables. And finally, this is also the RO volatility. We find the family firm exhibit lower volatility. We also we know that the risk-taking propensity is also defined at the firm level. We incorporate fixed effects, and we do find that our results hold true in the, when we use firm fixed effects. So we replicate that study with using firm fixed effects, same results. And finally, we explain that we give some explanation for our results. So finally, a firm may also pursue may diversify in order to reduce risk. So in that respect, we expect a U-shaped relationship between extent of diversification and family ownership. That is, at the lower level of ownership, family firms may pursue diversification, but at the higher levels, they may pursue diversification to reduce risk. And we do find a strong support of our hypothesis. In the similar way, we expect that they may use less or more risk. In that sense, we also expect a U-shaped relationship, and also we find that strong support of for the hypothesis. And these are the empirical results. As you can see that there exists a U-shaped relationship between diversification and family shareholding. And in also leverage, we expect a U-shaped relationship between family share leverage and family shareholding. As I stated earlier, that we expect a U-shaped relationship in cash flow volatility and family ownership, and we do find evidence for that. And finally, we explain our result with the help of cash holding, that family firms may hold cash may hold cash, more cash to reduce risk. So we expect an inverted relationship between cash holding and family shareholding, and we do find a strong support. And the reason for this, that we expect that high level of cash balance at medium level of shareholding act as a buffer and reduce the risk of the enterprise. So we do, as you can see, that there exists a U-shaped, inverted U-shaped relationship, and also old business family are associated with higher cash holding. So finally, we find that the relation between family shareholding and risk is non-linear. We do find that CEO belonging to business caste are riskier, and our study indicates that the social background of the founding family is yet another important variable in explaining the volatility at the firm level. Thank you.
Wonderful. Thank you so much, Ankit. We have a terrific discussion coming up. So if I can invite Shivatsan to start his discussion, please. Shivatsan, are you there?
I'm here. Can you hear me?
Yes.
Okay, wonderful. Thank you. So first of all, thank you for inviting me for this conference, and thank you very much for inviting me for this fascinating discussion on the impact of, I would say, business caste and ethnic background on the performance of a company and the level of volatility. So let me start by saying I'm not an academic, and so I'm going to make some comments that are based more on my business experience than anything else. And I do think that this is a topic that has been, discussed, I would say, whether it's in boardrooms or whether it's in drawing rooms. This is something that I'm sure a lot of people have discussed, and it's great to see an application of academic rigor to this question. And it's clear.
I'm listening to some webinar on finance.
Oh. Sorry, Shri. I'll mute everyone.
No problem. No problem. So it's very clear that caste has played a role in the evolution of businesses in India. And I would say that this is true. One could argue that this is true in the Western context as well. So there have been, for example, trade guilds. And it's also clear that, socioeconomic class plays a key role in the promotion of businesses. Gender obviously plays a key role that is also referenced over here. So one could argue that there's a role that all of this plays in the Western context as well. But it's very clear that to a large extent, it plays an even more important role in emerging markets. One of the things that I would like to ask is also whether this has to do with the stage of evolution of emerging markets. And I'll come back and talk about this more in a minute. But clearly, as you look at the evolution of emerging markets in terms of whether you talk about access to capital, regulatory structures, and so on, whether the importance of caste or ethnic backgrounds and groups and so on, the reason why they play such an important role is because of the fact that you don't have the scaffolding, you don't have the structures in place for businesses to really emerge. And the related point that I want to make is there's a reference to this paper, which I read many years ago by Tarun Khanna and Krishna Pillai on the role of business houses in emerging markets. One of the things they mentioned, in addition to what is referenced over here, I remember from reading the paper many years ago, was that these business houses are also, a repository of talent, that you're able to access talent in a way that a brand new company is not able to do. And so one of the questions to ask is that as markets become more open, whether that's still true or not. And there are two arguments to be made. One is that first of all, do you need to have access to the specific talents within an ethnic community or within a caste? And are you constraining yourself by doing that? That's number one. And number two, in an open market, do you really need to, really really worry about that when you have access to a lot more sources of talent. So that would be the other one. Uh, I would say that the biggest question in my mind is really around the time frame that was used. You have data up to 2015, and while 2015 is fairly recent, I would say that the world, especially in India, or the environment has changed quite dramatically. And one could argue that, you could say somewhere in the range of 2012 to 2013, there's been a significant shift in the overall environment. So as you pursue this line of questioning going forward, it'll be interesting to see what the impact of, multiple things has been over the course of the last, 5 to 7 years. One of which is obviously the Insolvency Act, which has come in, and the impact of that on business houses. You've seen a lot more failures. You've seen a lot more, a lot more business houses going into insolvency, whether it's specific group companies or the groups itself. But the more important aspect of this is that lending has become a lot more stricter and a lot more tight. And what the impact of this has been that, the earlier access to credit, which fueled a lot of the growth of business houses, the access to the banking system, the access to credit, whether that will continue to be there for these business houses and for these for the business groups. And so that's one thing to think about. The second is also the growth of venture capital and private equity as sources of capital. Now, that's been in existence for a while in India, but with the growth we've seen over the course of the last 5 to 7 years, will that have an impact in terms of the way there are opportunities for creating businesses? That there are now, you don't necessarily have to have access to capital from your caste or your ethnic group. You could go to potentially a venture capital a funder or even a private equity funder at a certain stage of the evolution. And so, will that have an impact in terms of the way people think about business creation? And then a couple of other things that I just want to maybe just highlight. One is really the this aspect of the impact of generations, right? So obviously, when you create a company, there was a mention of the Tatas and the Birlas. And obviously, we're now, into multiple generations of the Birla, certainly, and we'll see what happens with the Tatas. What's been the impact of, multiple generations on value creation? It's a slightly different aspect. It's not really looking at volatility. It's not looking at the amount of cash and the volatility in terms of ROA and so on. But one of the things, anecdotally, there's been a lot of conversation about is that after a couple of generations, maybe 3 generations, the ability of the family houses to really generate value comes down. And so it'll be interesting to see whether there's an impact of that or not. And the final question I would ask is that, we're talking about this in terms of emerging markets. And I think there's an implicit contrast between, let's say, obviously emerging markets and also developed markets, but maybe an implicit contrast between Eastern and Western. And what I mean by that is that we've seen the evolution of, these large business houses, whether it's in Japan and Korea from the 1950s and the 1960s, and, sometimes in the case of Japan, even before that. But they still continue to play a very strong role in economic activity in the respective countries. And that's not necessarily true when you look at the Western economies of the US or UK, meaning like the families, for example, in Toyota, the family still plays a very active role in places like Korea, like Samsung and Hyundai. The family still plays a very active role. You don't see many models like that. You see some of that in places like Germany, but they don't play an active role in the management of the company. So is there a difference between Western and Eastern models in terms of the way the evolution of these business houses happen? And does that have an impact on some of the questions that are being raised over here? So let me stop over there. But thank you again. This was a very, very interesting discussion and a very interesting question that was posed and obviously answered with academic rigor. So let me stop over there.
Thank you, Sri. I think one of the beauties of the EMF is being able to have these conversations between academics and industry and getting the perspective from the real world. And Sri, that was just a terrific discussion, and really brought some extremely grounding and framing perspective to the discussion here. We actually have a lot of, we have a fair amount of time for the question and answer. I think there's someone who's not muted. Could you try and mute, please, if that's possible? I'll try and...
It's me. I unmuted in anticipation to
okay,
say
Rama,
a few
no
words to
problem.
Shri.
No
It's Rama.
And no problem,
Can
Rama,
I
at all.
speak or can I
For sure.
jump in?
Go for it, then
Hi,
we'll go for
Shri. Great to see you here. Really a bit of a surprise because I wasn't really following who's going to discuss. So very, very nice to see you here, and so nice to get a very wide perspective from you. And as Yesha said, having this real world perspective is really very enlightening. And you've given us, of course, a lot of food for thought. I guess I have one comment to make on your comments and one question, if I may, on something broader. I was wondering what you thought about, I agree with you, since 2016, the milieu has changed enormously. And I think that was part of the reason, we decided to sort of a little bit arbitrarily keep our analysis till 2015, where we thought perhaps we had more of a controlled scenario within which to ask these particular questions. And in a way, you're absolutely right. A lot of interesting factors have emerged later, which we certainly should consider in terms of extending the paper or, writing another one. The difficulty of using a later period, of course, is that there's so many confounding factors that it would be hard to then isolate the type of questions that, we were asking in this paper. So that's a comment on your comments. And then a question, a more general question, because I've been thinking, as I think you may know, I'm in Denmark these days, and the Danish market is very strongly characterized by family firms, and they actually have an excellent data. I think the Scandinavians in general, and Denmark in particular, have beyond belief the kind of data they have. And so I have been thinking of, what sort of questions would be good to ask, particularly in terms of a comparison with India, and your insights in that would be, you alluded to it as, certain differences in Korea and Hong Kong, and more generally between Western and Eastern models. So if you have any specific thoughts now or later on what we might investigate, that would be very helpful.
Sure. And Rama, I must say that, when I raised this point about the more recent period, I completely understand that, it's very difficult to separate the impact of so many different issues. So I completely get that. So it was more to say that in the coming years, and I'm sorry, there's a lot of background noise, but that's okay. There's in the coming years, it might be an interesting line of questioning. Harsh, I think it's the Harsh that I know.
Yes.
Harsh,
Hey, Jay, good to see you.
Good to see you.
Good to see you, man.
Good to see you. There's a little bit of background noise. Yeah.
No, not from me.
So Rama, yeah, okay. So Rama, the point you made about the Danish market, I'll just make one comment, which is I don't know the Denmark, I would say, corporate sector that well. But the one thing, if you look at companies like Maersk and Novo Nordisk and others that come out of Denmark, they are now more or less professionally run. Their families don't really play a role in the running of the companies. And that's true in my experience of even seeing, companies that I'm familiar with in Germany that I talked about, like BMW, for example. So the question is that, does it make a difference when you compare, let's say, Denmark to India, if you do see, family still running specific companies and groups in India? And I don't think that's necessarily the case. at what point of time do you see the transition from founding families to professional management, so to speak, and what impact does that have? So let me stop over there.
Thanks, Sri. Thanks.
Terrific. We actually have quite a few questions coming. So Harsh and then Anjali, and we have some questions in chat as well. So Harsh, would you
I
like
have
to?
a question.
Yeah. So I have a whole bunch of questions actually. Hello, can you hear me?
Harsh, yeah,
Harsh, you
absolutely,
might have
go
to
for
pick
it.
one or two actually.
Sri,
because
good to see you, man. Yeah.
Very good to see you. Very good to
Yeah.
see you.
First, so this is an interesting topic, but I think there are some very, very important controls that have been missed. The biggest one to my mind is age of the firm. And here is the reason. Older firms tend to be in mature businesses. And those businesses by nature tend to have lower volatility, lower riskiness, and so on. And therefore, older business group will be in relatively more in mature businesses. So I think age of the business is a very, very important variable to control for. I don't know whether they have done it. I did not see it. Second important variable to control for is all measures related to stock. You have to control for floating stock. All these family firms have very low floating stock, public stock in the market, which is traded. In fact, many of them have extremely low levels of trading. Some of them, Tata Group companies might have higher level of trading. So you have to actually control for what is in India called floating stock, what is actually traded. So if you add the family and some insurers which also own a large chunks of these businesses, the floating stocks are sometimes less than 10%. And so all measures of stock market volatility I have to control for that. So those two are very important controls I feel that are missing. I mean, I could add a third to that, which is really the industry maturity. They have looked at her concentration, Herfindahl index, which I understand. It probably picks up competition, although not fully in my opinion, but certainly maturity of the industry is a very important variable. Maybe growth picks up a little bit of that, but not fully. Finally, in some hypotheses, the causality might go the other way around. So for example, it is not that business caste owners, companies tend to be risky, is that business caste owners tend to get into riskier businesses. That's why they are from business castes. That's what made that caste business caste. So I think we have to be also careful in drawing conclusions from the results. And finally, the point that Sri made that I also made, the picture could look very different in the post IBC world. There has been a clear change of behavior on part of family-owned firm. Sorry, let me stop there.
Thank you very much for your suggestions. So one point I would like to make is that we do control for firm size in all our regression. So if you have seen that we have control for log.
No, I meant age, not size, age.
Yes, we do. We control for firm age. That is log of firm age. We have control for it, sir. And for other variables, we do consider this variable in the next version of the paper. So and also for one point I would like to make that for the industry, we do include industry effects into that, which may counter the effect which are left out of HHI and growth opportunities. So I think that may be possibly the explanation for what you are saying, and other I would take it a point to include in the next version.
Anjali, would you like to ask your question?
Yeah, so I have again a couple of questions. The first is similar to Harsh's question, though I would look at age in a different way. One is there some different variation between the older listed firms versus the firms that listed more recently? So within your family setup, do more recently listed family firms show the same behavior as older listed family firms and vice versa? That's one. The second is there any effect of the presence of foreign ownership, which is foreign stock holding? So if an FII or a private equity investor in the company, is that something that you've checked for? Because I know that at least in the more recent period, most of the family firm listings are where a private equity investor is seeking to exit. So that would be something useful to check for. And one question that I have, which I didn't understand fully, is what do you mean when you say there is a U-shaped relationship between, and it came up in several places where it said that there is a U-shaped relationship between risk and the question is why, right? So you might be finding that relationship, but what mechanisms are likely to explain that relationship? If you could just sort of
Right,
explain
right.
that a little bit. Thank you.
Right. So for your first question, no, we haven't explored the firms that are listed in the recent as compared to the firms that were listed way before the period. As for the foreign ownership, we have considered only the institutional shareholding. We have not considered as per se the foreign ownership. We will definitely try to explore that. And third is see the U-shapes. The thing is, I started my presentation with that the behavior of the firms at different level, the behavior of the firm at the different level of ownership tends not to be the same, because as the ownership increases, the family firm have more skin in the game in terms of higher ownership. So their behavior towards risk taking may also change. So we are trying to explore their behavior at different level of ownership, because if they have less if they have less ownership, they may take risk at the expense of lenders, or they may have some insufficient incentives. But as the ownership increases, they may tend to take more risk, or maybe risk averse in that sense. So that is the main premise behind using the U shape or the inverted U shape relationship in the regressions.